Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. So this week I'd like to cover off setting up for 2022 Part 2. On November the 17th, I did setting up for Part 1, and what I looked at there was the sectors and how the big changes are starting to show up at the sector level on many different areas of the U.S. market. What I'd like to cover off this week is jump into a review of the commodities heading into 2022. 2021 had some real supply challenges. We saw natural gas shortages in Europe. We saw gas problems due to a cyber attack on a pipeline in eastern U.S. We saw problems with gasoline getting to Vancouver due to weather wiping out the pipelines and the railroads in Western Canada. We saw shortages in other countries like Japan where they had problems. We're having a lot of power failures due to the fact that we're struggling with wind production this year was a lot lower than, say, the peak. The peak, I think in Texas was 24%, and this year it's only been 3%, so that's a pretty dramatic change. All of those things are adding up to make commodities quite an interesting area for us to focus on. So the purpose of the show this week is to cover that off in a big way. Okay, let's jump into the charts. I'm going to start here with the Commodity Research Bureau. So what is the CRB? The CRB is 19 different commodities added together, but of that index, 40% of it is focused on fossil fuel related. So oil, natural gas, gasoline, and diesel fuel make up almost 40% of the index. So it's pretty meaningful. But I think the main point I want to drive home is it's not just in the areas of oil and gas that things have changed. We've had a meaningful step up in some of the ag products. Even though they're a small part of this index, they're breaking out as well. So I think it's a pretty valuable time for us to get set up for 2022 and try to make sure that we don't miss the ride. So first of all, here's gold setting up. And gold is very interesting at this juncture. And why do I say that? Well, first of all, we can see the big heady rise from 2002 to 2012, and then a pullback into 2016, and then a brief breakout here. So this is what we call a cup and a handle pattern, and we don't want the handle to fall particularly hard here. So as a percentage of the cup, William O'Neill would talk about 15% of the cup was strong. Now this is a big quarterly chart. Each bar marks 3 months. So what I want to point out is this is very big picture. It doesn't help us with short-term timing on a quarterly or on a daily basis or whatever. But it gives us the macro setup that if this is going to start breaking out of this downtrend here, this is an interesting time to get back into gold. And if we take and just open the chart up a little bit more, what we can see is, when we're looking for a macro trade here, let's just say that we had this big run up here, and then we pulled back and we tried to make a cup with handle and another one and another one and another one. It's very difficult to kind of see it in real time when you're looking at such a long picture. But the point that we really need to be aware of here is that if gold is going to start breaking out to new highs, this is a pretty important place on the chart. We would draw a trend line across our peaks here, and if this started to break out, we could expect a meaningful run into 2022, 2023. So I have been trading in and out of the gold trade since October. It's now early December. I'm recording this November 29th, but November 30th. What we're talking about is the macro view to try and be ready. So if gold all of a sudden starts to break through this downtrend, this could be almost a lightning strike sort of move higher. And what you saw was in the year 2000, as we had the tech unbubble, the tech market unbubble, so it was in a bubble and it broke out. What we saw was a big change in character here, and after it got moving, I actually thought the fourth quarter of 2022 or 2021 would do it because we went below our moving average and then back above. And we see that in here, and then we just have to watch how this shapes out. But we're looking for this same sort of base here. And then we want to watch for a big run up. So that's kind of one of the major perspectives on gold. And if we're going to run into a big inflationary cycle, this would be one of the areas that should run hard. Now, silver isn't quite as bullish because it is nowhere near the highs we hit back in 2011. It's sitting at around $22, and our low was, I'll call it sub $12, right at the bottom of COVID when everything was selling off. So the chart went and made new 10-year lows and immediately reversed and popped higher. And now we've run up, we're what we call bull flagging. So you make a flag pull where you've got big move, and then you kind of build this flag where the market just consolidates and then it starts to turn and burn higher. A move above $25, I think, for silver would be an interesting place to be aware of any sort of trend change. So just as a number in the back of my head, that's kind of a good place to think about. And again, we got all the way up to $50 back in 2011, so roughly a halfway point. And if we can start to see that go higher, so after dipping below this long-term moving average, this is a 5 quarters moving average. If we can get back above that, I think that's a pretty tasty place on the chart. Lumber had an unbelievable 2021. It went through this massive move from 300 all the way to 1700. We never saw anything like it. And I took the Rocky Mountain Rail Tour through Western Canada in September, and this was after the big lumber price spike higher and it had pulled back. And what was really obvious to me was that a lot of the lumber yards were starting to carry a lot more inventory, so that was making it the surge we had due to the big building boom in the U.S. coming out of the COVID situation. And what happened there was many people were living at home and decided to upgrade their homes or move to new homes rather than, sorry, I said living at home, working from home, and then decided to upgrade their homes because they were spending time in it and they thought they could work more remotely and spend a little bit more time at home. So they were all on the upgrade cycle. How home builders really took off to the upside. Now, what we see in lumber is it traded down below this 5-period moving average and has now tried to start working its way higher. So it's a pretty interesting zone to watch for. And if this can break out to the upside, I think there's a good reason for us to be ready if lumber can turn. And we're starting to see the home builders look okay again. So it's another reason to maybe get set up for that trade heading into the fourth quarter. So copper has been one of the more difficult trades really since May, and one of the reasons for that is it broke out to new highs, all-time highs in May, got up to 478 or something like that. I guess we could go inspect that. So on this bar, what was our high close there? 489, and then currently. In the fourth quarter of 2021, we're sitting with the top price at 482. Now, can we go back and take that out? That's a really good question. So far, we're sitting on that upside channel. The channel, I'll call it, or the moving average from the 5-quarter moving average, and things are trying to push higher. And again, whenever we're at a prior high, we want to be aware of, first of all, the resistance at that level. But if we continue to keep pushing, so we pushed once through the prior high in the fourth quarter, we've pushed again through the prior high. If we start to see a big breakout on copper to the upside, that can be very, very opportunistic time to get back on board and try and ride this trade a lot further. So I'm quite excited about the positioning of copper heading into 2022. a breakout there, and it could probably double again just based on the fact that electric cars take more copper. We're trying to put charging systems into people's homes. I think that's the huge mistake where we're adding more batteries to every home because we don't recycle them properly. There was a recycling fire in Calgary where I live due to batteries being thrown out, not properly disposed. They got into the recycling system. We had a big fire there. I think we're setting ourselves up for an environmental nightmare by having so many batteries in homes, and we would be better off to doing batteries at the local grid level, so on a neighborhood basis instead. But obviously, I don't get to design the world, just get to trade it. I'm looking for copper to have an explosive move again in 2022, and I want to be ready for that trade. This is the industrial metals index, and what you see, again, we got up to prior highs. We made a new high, and then we pulled back. And in the fourth quarter, be aware of the momentum here. So we had big momentum, big momentum, big momentum, a little shorter, about the same, shorter, shorter. And so it wouldn't be a surprise that we start the first quarter with a bit of a lull in industrial metals. That would be copper, steel, aluminum, that kind of stuff. And as we roll down, then being ready for the turn back up. Now, it's kind of hard to just take the industrial metals as a group. We use aluminum for things like planes, and there's more aluminum going into cars. There's also aluminum in the long transmission lines. All of those things can help us out. Just being aware of their current stature and how they're working out. I think as a group that area should improve based on the back of the electric vehicle trade. So at the end of November, West Texas crude has fallen almost $20 from the high, roughly hit in November. So I think it was down $18 before the end of the month here. So within the month of November, a big move down. Now, what we want to be aware of, a couple of things. Well, if the global demand is going to return through the end of COVID or whatever, one of the big things that happened in oil was $110 and it fell down. I'm going to take off the log scale on this chart and just make it normal. Let me just do that, save. And the reason I want to do that is the log scale squishes the top part of the chart due to percentage change. But the bigger view here for West Texas crude is we did take out the 2018 high. We have broken this big downtrend, and you can see this PPO trend line breaking much like it did on this CRB chart. And again, oil's a big part of that CRB index, the Commodity Research Bureau index. So for me, I want to watch in 2022, I want to try and buy crude oil near the lows. I don't like to buy crude oil up near prior highs. I want to buy it on pullbacks and be watching for the turn up. So using shorter term charts to try and make that turn. Commodities range trade. So as an example, here's 2015, 2016. We traded in a $40 to $60 range for almost 3 years there. Buying the breakout on all of these is a little more difficult. There's not much upside, whereas trying to buy very close to the lows using shorter term charts, we can get some lift, and sometimes we'll end up getting one of those big runs. The current pullback in oil, I think, is a big buying opportunity. COVID had a lot of people quit the industry because oil went below zero for overnight. We also had a lot of people in the field who decided they were no longer willing to work out in the field. They were going to go to tech jobs or day trade or whatever. And they didn't want to be out in the field on a cold night at midnight, driving through the fog, looking after an oil well, and all of a sudden everybody's saying, oh, you work for the dirty oil company. So enough of that. And people have genuinely pulled back from the industry. We still need a lot of oil, and unless you've parked your car and turned off the natural gas in your homes, we're all part of that consumption. So we need to be aware that the industry has really downsized in staff and might not be able to rebound as quick to get back to prior levels. Higher prices usually solves the problem of higher prices. In other words, as soon as price goes up, then more investment returns to the commodity. The problem we have here is a lot of technology, a lot of people that understood what was going on in all of these reservoirs have left the company due to the severe downturns and lots of layoffs. And that's happened over a 7-year cycle, really from when oil fell out at 2014. And there's been layoffs almost every year in the patch. So to finally have an up year is a nice relief. People think that $85 oil is normal. I will just say that the minimum cost for producing oil is now closer into the 60s. You can have some longer term reservoirs that might be able to do that, but what happens is when you have a reservoir, it's like a gas tank, and as you draw oil out of it, you have to go find new ones. And until we get back on that cycle of finding new oil and we keep draining the oil in the ground, we're going to create a situation where we have some tightness of supply while we try to convert over to renewables. I still think that's a big window, like 5 or 10 years. There's lots of investment that could go on in oil, and I wouldn't be surprised at all to find this up challenging the top of the 2011 to 2014 range. Natural gas, really a spiky chart. One of the things I always notice on this chart is you get these huge surges and pullbacks. So breakouts on here, you have to be very cautious. And as we're talking at the end of the second month of the last quarter of the year, natural gas had a huge run up, and it's called the Widowmaker trade for a reason. Literally, it runs up, and then just when everything looks great, it plummets. It's currently doing that, ending November near the lows of the month. And so as we're watching natural gas trade so volatile, in Europe it's over $30. In the US we're sitting here right around $5. There's not enough LNG tankers taking it back and forth across the water, so we really need to think about localized trade, but there's a lot more LNG terminals being built and shipping. This could help normalize with the prices in Europe. So I continue to see pressure to the upside, but I expect this to fall back down. I'll call it into the $3 to $4 range, and then at that point we probably want to look for a better entry. Wheat has been slowly climbing every quarter. It's just a nice little uptrend. Corn goes into ethanol, so as crude gets more expensive, then corn gets more valuable. They take it away from food supply and move it into fuel. When that happens, that puts pressure on soybean and wheat to kind of backfill some of the things corn was doing. So we end up changing the dynamic of our food supply by putting corn into fuel. All of that leads to the fact that the ag sector looks wonderful for 2022, and I'd encourage you to keep that one in mind. And that could be through fertilizers, and that would be Mosaic, Bunge, Nutrien, CF Industries, those types of companies, or playing it directly maybe through actual Archer Daniels Midland or something like that. Cotton's been rising pretty much since the COVID low and is actually sitting very close to 10-year highs. Actually, it did hit 10-year highs now this quarter. So as we're watching, again, 2011, all of the commodities kind of ran up and topped out. That's not how this looks yet in terms of relative performance to the S&P 500. We're just still kind of performing in line with the S&P. But I do like the fact that this big downtrend is broken, and I expect more price action in here. And again, I think it's the changing industries that's causing a lot of pressure on these commodities. People have left it to go to tech or to, there's been so much money made in the stock market, people are staying home to trade now rather than going to a work, even though they're educated in a different job. I think the one thing to keep in mind is commodities are always needed. You want to buy them near the lows and be careful near the highs. We had a big run up in corn here, a pullback, and now if this started to turn and burn higher, I still expect that to work out again on the back of the crude oil contract. Okay, I think, let me just see here. So when I roll back into the big picture for commodities, to me, I think we still have lots of upside left. That doesn't mean it's a straight line. one of the things I'd like to show a little bit now is just jump into my regular commodities newsletter, which is a lot shorter time frame. Just show this setup for energy on a shorter time frame. So here's West Texas crude, and you can see we have come down. Crude support looks to be in around $65, $66. We're sitting here at the end of November right around the $68, $69 level. If this is support, I want to be looking in early 2022 to start buying that back up and enjoying the run probably into April-May timeframe, maybe a summer lull, and then looking again for the fourth quarter. So to me, oil's actually more attractive here now that it's no longer at 85 and down here around 66 or 70. At that pullback point, again, trade it differently. For me, I want to trade it different than technology. I know a lot of people like to buy technology as it breaks out. Oil is different that way. You want to try and get the run from the low back to the high of the range, not from higher than the prior high and a little bit higher. That there's not a lot of room there. And if you go back and look at the charts, even this breakout here ran up, barely made any headway, ran up, barely made any headway, pulled back. A lot of times when you're trying to buy these breakouts, it's too short a window. So I like to look for downtrends that are breaking, and then when they start to crank up to the upside, that's more powerful. Now, one of the interesting things that happened in late 2021, again, oil trading up around $85 at the beginning of the month and now trading down near $65 or $66 at the end of the month. That's a big move, right? That's $19 down. Well, if I show you the XOP, which is the Exploration and Production ETF, it's down here in the middle panel. It's pulled back roughly 20%, somewhere in there, but a lot of the stocks have actually held up in a sideways range, and I think it's those types of names that we want to be a little bit more aware of. When oil drops like this, it's usually telling us that there's pressure on other parts of the market. So I always find oil's a good clue to watch for wider breakdowns. Let's say that oil is a clue here and it's starting to drift lower. As oil drifts lower, what we need to be aware of is the potential for that to spin off and cause problems in the equity markets in general. It's telling us about economic weakness. There's a lot of bright traders, and quite frankly, a move down of $20 is saying something's very, very wrong, as opposed to just trading in a sideways range or whatever as the market is trying to figure out COVID demand. I still think the big trend is up. Here's the 200-day moving average for XOP. As you come in here, even if it comes down to $90, to me this is a more attractive place to buy it than trying to buy it up here around 110, 112 as it broke through 100. This is just a better place to look. So I want to be looking as it bounces off the 200-day moving average than trying to buy it up near the top. On a weekly chart basis, what you'll see here, big long-term uptrend. I don't like the fact that the momentum is rolling over here. But again, if the overall economy is going to pull back, I want to be tactically watching for the lows in commodities to try and get back on the bandwagon rather than buying them on the breakout. So if you do get these weaknesses, you want to be flagging periods around typically it's nice when it stays above the 10-week, which is a 50-day moving average. If it can't do that and it starts to pull back, I want to be looking at the 100, the 150, 200-day as it comes down, and then just use, a shorter time frame chart like a 60-minute chart and say, okay, what's the trend? It's still down. Is there any news there for us? Well, maybe not. Well, let's go to the daily. Okay, this still looks like it's in a downtrend. We don't have any reason to get involved yet. PPO momentum is sliding. If this can start to turn back up on a daily basis and you start to get your PPO swinging to the positive side, that's a much better place to start to look for an entry back into the oils than trying to take new positions up at a high where the PPO momentum indicator is rolling over. Now, again, this rolled over roughly on the 18th of October. It traded sideways for a whole month, and only now is it starting to break down. I think what's interesting about that is all of us are expecting oil to continue to go higher, and yet here we are where it did nothing for a month and starts to weaken. How investors are moving their dollars can really help us understand what's going on. And so a turn back in that chart from XOP and oil down to starting to break back above, PPO momentum starting to improve, all of those things would make for a much nicer entry in 2021, late 2021, early 2022. And when that cycle starts to pick back up again, I think you want to be on the gas pedal here, trying to pick up some of these names. So that one's a really important one for me. I'm going to cover copper a little bit more in depth because I'm trying to buy copper. I'm starting to see some stability in the copper charts. Now, that doesn't mean it's going to work out yet. What you see here is this downtrend on momentum. Again, coming down near zero. If we are in a bull market for commodities, it should bounce around here. So this is the place I want to be looking closely. Now, you can see prices jogged sideways. It is below the 40-week moving average. There's nothing beautiful about that. If it got down here to let's say the September lows, I'd be looking to try and buy it again. Same reason as a commodity, you want to try and buy it near the lows and then watch it turn and burn higher. The real question is if that doesn't happen and it starts to make new 52-week lows, 10-month lows or whatever, clearly the economic demand is lightening and China's a big part of that, so it's not just a US play. If we can start to see that rotation out of the downtrend and back into the uptrend, that's pretty important to get involved with. And copper loves to do this sudden spike and then fail. I wrote an article, it's on the StockCharts website and on gregschnell.com, about copper and how it typically makes a double top and then falls away. Well, this has been chopping me up. I've been trying to enter on the long side for some of the copper charts pulling back and then starting to break out. And I've had numerous failures, 3, 4, 5 different companies, small losses, but at the same point, the trade's just not working out yet. So we're gonna need to see this momentum indicator start to base here and turn up, and as it does that, that might make a better entry. But right now, it's still difficult to get on board. Now, if we go, so this was copper itself, and you could just see it's down roughly 1% on the week. If we go look at the copper miners, they're up 1% this week, so they're trying to hold in there. But I think the real question will be if it doesn't work, and they all of a sudden, like if this starts to move below, let's say 32.88, that puts us at there's a 32.71 in here. Anyway, we're getting down to the lower end of the range. We're sitting at 35.12. If we can get down a little bit lower, that might make for a more attractive entry than an exit. So with that, thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern. You can also see the recording on StockCharts TV. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe